over $100 billion. That is how much money was locked inside decentralized finance protocols at the peak of the crypto boom. No bank executives, no loan officers, no government backstop, just code running on a global computer network that never sleeps. If you have ever wondered what it would look like to completely reinvent the financial system from scratch, you are watching the right video. Let us start at the beginning. DeFi stands for decentralized finance. It is a broad term for financial applications built on blockchain networks that operate without traditional intermediaries like banks, brokers, or exchanges. Instead of trusting a company to hold your assets and execute your transactions, you trust the code. And that code is open source, meaning anyone in the world can read it, verify it, and use it. The backbone of DeFi is the smart contract. A smart contract is a self-executing program stored on a blockchain. You program the rules, and the contract enforces them automatically. There is no human in the middle who can make exceptions, freeze your funds, or take a cut without your permission. Think of it this way. When you walk into a traditional bank and apply for a loan, the bank checks your credit score, verifies your identity, decides whether you qualify, and charges you an interest rate that benefits them. The entire process is controlled by a private company whose primary obligation is to its shareholders, not to you. In DeFi, that same process can happen algorithmically. You deposit collateral, a smart contract evaluates the math, and funds flow to your wallet in seconds. No paperwork, no waiting, no credit check, no middleman taking a margin. Most DeFi lives on Ethereum. Ethereum was specifically designed to be programmable, and it attracted an entire ecosystem of developers who wanted to build financial tools on top of it. But today, DeFi has expanded to other blockchains as well. Solana, Avalanche, BNB Chain, and Polygon all have their own DeFi ecosystems. The competition between chains has driven innovation at a pace that would be impossible in traditional finance, where legacy infrastructure and regulatory inertia slow everything down. Now let us talk about one of DeFi's most revolutionary inventions, the decentralized exchange, or DEX. In traditional finance, if you want to trade one asset for another, you go through an exchange like the New York Stock Exchange or Coinbase. That exchange holds order books, matches buyers with sellers, and keeps custody of your assets. In a DEX, there are no order books and no custody. You keep your assets in your own wallet at all times. So how does trading actually happen? This is where it gets genuinely brilliant. Most modern DEXs use something called an automated market maker, or AMM. Instead of matching buyers and sellers directly, an AMM uses pools of liquidity. Imagine two buckets connected by a pipe. One bucket contains Ethereum. The other contains a stablecoin like USDC. When you want to trade Ethereum for USDC, you pour Ethereum into one bucket. The other bucket automatically releases USDC to you, and the ratio between the two buckets adjusts to reflect the new price. This formula, known as the constant product formula, was pioneered by a protocol called Uniswap, and it fundamentally changed how we think about trading markets. Those buckets of assets need to come from somewhere. They come from liquidity providers, or LPs. These are regular people like you and me who deposit their crypto into these pools and earn a share of the trading fees in return. Every time someone uses the pool to make a trade, a small fee is collected and distributed proportionally among all the liquidity providers. This created an entirely new way for people to earn passive income with their crypto assets, simply by contributing to the infrastructure of a market. This brings us to one of the most exciting and misunderstood areas of DeFi, yield farming. Yield farming is the practice of moving your assets between different DeFi protocols to maximize your returns. When DeFi protocols first launched, they needed to attract liquidity quickly. To incentivize early users, they started distributing their own governance tokens as rewards on top of the regular trading fees. Suddenly, providing liquidity did not just earn you a share of trading fees. It earned you tokens that represented ownership in the protocol itself. At the height of DeFi summer in 2020, some of these yields were in the triple digits, thousands of % annual returns. Obviously, these numbers were not sustainable, but they drew enormous attention to the space and accelerated the ecosystem's growth dramatically. Beyond trading, DeFi also created decentralized lending and borrowing markets. Protocols like Aave and Compound allow users to deposit crypto as collateral and borrow against it. The interest rates are set algorithmically based on supply and demand. When there is high demand for borrowing a particular asset, the interest rate rises automatically to attract more lenders. When demand is low, the rate falls. This is a financial market running entirely on mathematics and code, adjusting in real time, 24 hours a day, 7 days a week. Now for the part that most YouTube channels skip over, the risks, and they are significant. First, there is smart contract risk. If the code has a bug, an attacker can exploit it and drain the entire protocol. This has happened dozens of times. Hundreds of millions of dollars have been lost to smart contract exploits. The Poly network hack lost $600 million in a single afternoon. The Ronin bridge attack drained $625 million. These are not fringe incidents. They are the cost of building financial infrastructure in public before it is fully battle-tested. Then there are rug pulls. A team launches a new DeFi protocol, attracts liquidity, builds hype, then quietly drains the liquidity pool and disappears. Because DeFi is permissionless, anyone can launch a protocol. That is both its greatest strength and its greatest weakness. There is also impermanent loss for liquidity providers. When the prices of the two assets in a pool diverge significantly, liquidity providers can end up with less value than if they had simply held the assets. This is one of the most counterintuitive concepts in all of DeFi, and many people do not discover it until it is too late. So where does DeFi go from here? The honest answer is that we are still in the very early innings. The protocols that exist today are the rough drafts. They are brilliant, but they are also complicated, risky, and largely inaccessible to the average person. The next wave of DeFi is focused on solving those problems. Real-world asset tokenization is bringing traditional financial instruments, mortgages, treasury bonds, private equity onto blockchain rails. This creates an entirely new class of collateral and opens DeFi to trillions of dollars in assets that currently sit in traditional financial systems. Institutional players are beginning to engage as well. JP Morgan has run experiments with tokenized settlements. BlackRock launched a tokenized money market fund on Ethereum. These are not small signals. These are the largest financial institutions in the world quietly testing the infrastructure. Layer 2 scaling solutions have dramatically reduced the cost of DeFi transactions, making it practical for everyday users rather than just wealthy whales. And cross-chain bridges, despite their security challenges, are building a more connected DeFi ecosystem where assets can flow freely between networks. DeFi is not a guarantee of the future. It is a bet on it. A bet that open, transparent, permissionless financial infrastructure will ultimately outcompete the closed, opaque systems we inherited from the 20th century. Whether that bet pays off depends on the builders, the regulators, and yes, the people watching videos like this one who take the time to actually understand what is being built. If this deep dive gave you value, subscribe to Crypto Compass. Every week we break down the most important developments in crypto and DeFi, so you never have to miss what matters. I will see you in the next one.